Hello, students. Hello. Yeah. Yeah. So we have missed many classes. I think 2 weeks we didn't have any class. So we should have class Saturday, Sunday. So today we will study chapter 24. I think we stopped measuring domestic output and national income. So in this chapter we will GDP and GDP price index, nominal GDP, real GDP, limitation of GDP measures. I think we studied some slides in this chapter. So here in Sri Lanka, the census department, central bank, they calculate the national income and account. So we should calculate this. We can use that one to assess our economy. So this is one of the measures to assess we can see how the economy progress in the long run. So track long run course, and for the policy, formulate policy. For this purpose, we compile national income and product account. Domestic product, GDP plus domestic product producing in economy. We have produce services. So we value all the goods and services produced in a country during a period. So in 2021, the total value of final goods and services produced, the value of final goods and services in the country within the, so that is the GDP. So this is, so when we aggregate all the commodity, then we have to use the value, the monetary value. Otherwise, we could not aggregate because different commodities and services. So yes, value, price. So then we value this, all the goods and services in a monetary measures in rupees. So when we calculate this GDP, we should avoid multiple counting. So now when you buy bread, so that is the final goods from the wheat, then flour, then bakery cost, then we get bread. So we should value the bread, not the wheat flour or the bakery, the other intermediate product. So when we different products, which they are before final goods. So if we value all the goods, then we are overestimate. So we should value, the GDP definition says value of final goods and services. So for the final goods and services, we need intermediate goods to produce. So we should not value that intermediate goods. Then it's like a double counting. So the GDP says the value of final goods and services. So market value of final goods. So we should ignore intermediate goods. So we should not include intermediate goods into the GDP calculation. Then it's mean double counting. Already that intermediate goods value in the included in the final goods and services. Wheat flour is a intermediate goods that is already value. It's included in the bread. So if we value both separately and sum up, then we are overestimate our GDP. So then we should ignore intermediate goods. Anyway, to avoid this double counting, if we use value added procedure, that means from the farm land up to be consumed, or from the steel until up to the car or automobile. So there are many firms involved. So to avoid the double counting, we can do value addition of each firm. So farmer use seeds, fertilizer to produce wheat. So the wheat is the output. Input, he use seeds and other inputs. So then value addition by the farmer is the value of wheat product minus input cost. So that is the value added by this farmer. Then wheat go to the mill. So then wheat flour is the output of the mill. Wheat is the input. So the value added in the mill, value of the wheat flour minus wheat. Then if a bakery product, so for bakery product value minus input used in the bakery, wheat flour, labor and everything, energy, electricity, everything. So if we sum up value added all the production unit from the farm to bakery, all the value added by the each production unit, if we sum up that value addition, that is the value of final goods and services, value of the bread. So to avoid the double counting, if we sum up the value added in each production unit, we will get the value of final goods. So we can avoid double counting if we use the value added procedure. So that is one method to calculate gross domestic product to avoid the double counting. So GDP is market value of final goods and services. We ignore the intermediate goods, or we can use the count value added procedure. So then when we calculate count the estimate the GDP, we should exclude financial transaction, these financial transaction, public transfer payment. So when we, even in the value addition, to find out the value of the final goods and services, we include each unit transaction. So from that financial transaction, we calculate each unit the value addition. But when we should exclude any financial transaction like public transfer payment. So government give the citizens or others some subsidy or transfer payment tax. So public transfer payment. So if the government give some subsidy or 5,000 rupees for the COVID, due to this COVID, the poor family get 5,000 rupees. That should not be counted in the GDP. That financial transaction is not counted. But when you buy any goods or services, that financial transaction is considered or included in the GDP. That is for a production, a product produced, new product produced. For that, money transaction is considered in the GDP. But this 5,000 rupees, it's not just transfer payment from government to that poor family. Here, this transaction is not involved in any production. It's not produce anything, just money transfer. So then this transaction, it's not be calculated or included in the GDP. It's not producing anything. Any transaction produced, any goods involved in the production, that only that one is considered in the GDP. That is value addition. And private transfer payment. So your parents give money to you. So that money is not involved in any production. So that transaction also should not include or in the GDP. Only money transaction that is involved in the production will be considered or will be included in the GDP calculation. And stock and bond market transaction. So in the share market, the investors are buying and selling the stocks share they have, company shares. But that is only transaction between two investors, public. There are no company is not involved. That money is not going to the company. So that transaction also it's not involved in the production. But when the first time when the company issue stock, that is they borrow money from you by that share. That is for the production. But after they issue the share, then people transfer buy and selling between them. Then that money is not going to the company for the production. So that is also not considered the GDP. And second-hand sale. So if you buy old car or any second-hand sale, so that money transaction is not producing any new product. So that is also not considered or included in the GDP calculation. So only transaction that involved in new production that is considered to calculate the GDP. So we can calculate GDP by two methods. One is income approach, other one is expenditure approach. You already studied the circular flow of the economy. All the resources or factors of production that needs for any production is supplied by household. Households are owner of all the factors of production. Business sector purchase these factors of production from the households and produce goods and sell back to the product to the households. Then households pay for that. That is expenditure, household expenditure. So for the supply of factors of production, land, labor, capital, entrepreneur, ability, all households resource. They supply these resources to the business sector. Then business sector pay income for all these factors for the supply. So the government also involved. Governments also need this goods and services. They purchase from the business sector. So then the income received from the household should be equal to the household paid for the consumption expenditure. So then these two should, income approach and expenditure approach, measure the total GDP. Both should be equal. So we can use two approach. Income approach. So in the income approach, we count income derived from production. So the household supply labor. For that they will get wages. Household supply capital. So for that they got rent income. The land, the household supply land. Land also one factor. For the land they get rental income. For capital, they supply capital, they got interest for that capital. Entrepreneurability, the household supply, then for that they got profit. So four factors of production involved in any production, that four factors of production receive income. That is in the form of wage, rental, interest, profit. So if we sum up these wages, rental income, interest and income, profit, then that is the value of goods we produce in the country during a time. So in another way, we can calculate the value of final goods and services produced in the country using expenditure approach. So all the goods and services are purchased by households, government, even business. So capital goods, business firm need machinery, tools. So business, one firm buy from another firm machinery, tools and other thing. So households, business sector, government sector all purchase goods and services. For that they are paying. So the expenditure of all these expenditure, if we sum up, we got the value of final goods and services produced. So in a particular year, so that is this income approach and expenditure approach, the count value of final goods and services should be equal. So this two approaches. So consumption by household plus investment by business. So if business sector purchase capital, tools and machinery, raw material, then we call investment. Households for the consumption, then that is consumption expenditure. Government purchase goods and services to supply the public service, so government purchase. And also the foreigners, they spend on the our product, so expenditure by foreigners. So these are the expenditure approach. So if we sum up all these, that gives the value of final goods and services produced within the country in a particular year. So income approach, the households supply all the resources, factors of production. For that they get income. So for the labor, they get wage. For the land, they get rent. For the capital, they get interest. For their managing ability, so get profits. So, and when we equal these two approaches, we should add some statistical adjustment. So the expenditure approach should be equal to the income approach. Both should be equal. But when we sum up wage, rent, interest, profit, it should not be balanced. There are some adjustment we should make because some profit and other things is not directly go to the household. So we will see that is statistical adjustment. Then both should be equal. So in the expenditure approach, the household expenditure, that is personal consumption expenditure. So they spend money, durable consumer goods. You know, some goods we consume that is durable for at least 13 years or something. Some are non-durable consumer goods, so foods and other things, many things, non-durable consumer goods. And also we are spending on the services, education, expenditure, health, so other mobile, the phone service and many things service, consumer expenditure for services. So this personal consumption expenditure, the households, our domestic household expenditure include domestically produced goods and foreign produce. So all the smartphone are produced in foreign country, automobile. So many product we import. So our consumption expenditure include foreign product also, and domestically produced product also we consume, but we include that also here in the, but we should value only domestically produced goods and services for the GDP. Now in the consumption expenditure, we include goods produced in the foreign country also. So then we, in the last component, expenditure by foreigners, we remove that one. We will now we include all the consumption expenditure, household consumption expenditure. We include domestically produced and foreign produced also. But when we will subtract that one foreign produced goods in the in the component expenditure by foreigners. So we will see that. So then that is household consumption expenditure. Now business sector expenditure, that is if the business sector spend money, that is we call investment. So gross private domestic investment, gross private domestic investment, that is business sector spend money. So they need machinery, equipment and tools, then they spend expenditure. And all construction, building for the business purpose. So that is also the investment. So firm need factory, so building to produce product, so all construction, and also changes in inventories. So they have inventories, the finished goods or raw material, everything inventory. So that is they purchase or they produced and store. They produce many goods, they sold, some are in the store, that is also produced in the during that year. So changes in inventories, all the fully produced or partially produced, and the raw material, all the expenditure they use, that is investment. So machinery, equipment, tools, all construction, building and other things, and changes in inventories also part of the private domestic investment. So or anything creation of new capital asset is the investment. So we spend any money for the second hand sale, that is not investment. So any creation, the expenditure we spend to create new capital assets. Capital assets mean machinery, equipment, tool, construction, building, and inventory. So creation of new capital asset, that is investment. Non-investment transaction, so that is earlier we saw, that is transfer payment, government public transfer payment, private transfer payment, the transaction in the share market. So those are non-investment transactions. Okay, then so gross investment, gross private domestic investment. So net investment mean we should depreciate. So all these capital, machinery, equipment, tools, buildings, everything has depreciation. The value decrease over the years, or when we use it, machinery, tool, equipment is used up. So we run. So then we should then we run the buy the machinery and use it for a year. Then if there are something wear out, so that we need to replace that parts. So otherwise we cannot run that machinery. So if this some wear out, then we replace by the new parts, that is depreciation, that is equal to depreciation. Building, it's the for life period of building, 50 years or something, every year that value decrease, that is depreciation. So then the stock of capital to replace that maintain, we should invest, that is depreciation. So maintenance to the capital. So the total capital increase, we deduct this depreciation. So net investment, gross investment minus depreciation. So if there is increase net investment, then the country capital increase. So, but when we calculate GDP, we only consider gross domestic product. When we calculate gross domestic product, we don't consider depreciation. Then from the gross domestic product, we will calculate net domestic product, then we depreciate this depreciation. Not for the GDP, we consider gross private domestic investment, we don't consider depreciation. You will see later from GDP, if we deduct the depreciation, we will get net domestic product. So expenditure approach. So we have seen household expenditure, consumption expenditure, business firm expenditure, that is investment, gross private investment. Now government. Government also spend money on goods and services they purchase. So expenditure government purchase include expenditure for goods and services. Government to run the government and services, provide services, public service, they need goods and services. So they purchase. So that is expenditure. And expenditure for social capital. So the schools and the highway, roads, and these are public owned resources. So it's not private. So public owned resources. For that they invest and purchase goods and services for the construction of school and road construction of road. So expenditure for social capital. But we should exclude transfer payment. Government give subsidy to the citizen people that is not involved in the production, production. So that should not be considered. Other government expenditure, all other government expenditure is the we should consider in the calculation of GDP. But government giving subsidy to the people, farmers, poor citizen, so samadhi, so those things are not included in the as a government expenditure in the GDP. We should not count that one because that is not involved in the production. Then net export. So now we are producing, exporting, and we are importing also. So the net export, export minus import. We should deduct the import expenditure because in the GDP we should consider only domestically produced goods. But in the already we count the import in the consumption expenditure. So domestically produced and foreign produced goods we included in the household consumption expenditure. So from here by adding this net export, we deduct that import. So now the calculation only include the value of goods and services produced within the country. So we export. So all export goods produced in our country. So that should be included in the GDP. But import that is produced in another country. So that should be deducted or subtracted from our consumption expenditure, household consumption expenditure. Already we included that one. So here by net export, export minus import, that is net export, then we deduct import. We include export in the GDP. So net export at exported goods, subtract imported goods, that is net export. So now GDP has this expenditure component: household consumption, private firm investment, that is gross domestic private investment, and government expenditure, and net export, that is export minus import. So now this GDP count all the expenditure spent on the domestically produced goods. So this is expenditure approach. So when we see the expenditure and income approach, this is US example. Now you can see personal consumption expenditure, gross private domestic investment, government expenditure, net export. They sum up. That is then gross domestic product 13,841. Here the net export is minus. That means they consume more than they export. So export minus import. So that means they consume more than their export. So net export is minus. So the income approach, compensation for the labor, rent for the land, interest for the capital. If the private firm, so that is their profit. So owner, sole owner or partnership business. So single owner firm or partnership firm, that firm profit, that is we call proprietor's income. And some firm are corporation, companies. So not a single owner or partnership. So many public invested by buying share stock. So that is corporation, company. That company corporate profit. And taxes on production and imports. So that is income go to the government. So that is taxes on production and import tax go to government as a revenue or income. That is also we include. Then we will get national income. This is not GDP. If we sum up compensation, rent, interest, proprietor's income. So interest. So this interest may include capital supply in the production, in the domestic production, or this interest, this American invest or provide capital to other countries. Other countries pay interest. So if they invest in other country or give loan, the private or someone bank give loan, that loan interest go to American. So then this interest not only from the domestic, the supplied capital. So internationally. So then this interest include for the capital supplied domestically produced goods or foreign produced goods. Proprietor's income. So single firm, owner firm, they can get income if they invest in other countries. This American invest, single owner company invest in other country, they got income. So that is proprietor income. So this income not only count the domestically produced goods, produce income from other country production also, and corporate profit. Also, the income not only produce goods in the America, the big multinational companies have company in other countries. So that income also included in the corporate profit. So all the resources supplied by the Americans domestically or internationally counted in the corporate profit, proprietor's income, interest, all So then, and taxes on production and imports. So that is import tax, that is produce. So government. So if we sum up this, we don't say GDP. This is national income. That means the country, all the resources supplied by the Americans receive from the production domestically or international. That is national income, not the GDP. So from the national income, they deduct something and add something, then they got the GDP. So net foreign factor income. So now 96 million or billion dollar net foreign factor income. That means the resources, American supply resources to produce in another country. So that is, we should deduct from the national income to calculate the GDP of the America. So they subtract net foreign factor income. So if the foreigners, others, European invest in the America, that should be counted in the GDP, that income. But American invest other countries, that income from that foreign produce goods, they got income for the investment, that should be deducted because that income from produce other countries. But the European invest in America, that should be counted in the GDP because that product, even that income go to Europe, but that is produced in the America, that should be counted. So net factor income mean like net export. So if the foreign factor income, domestic factor income subtracted. So if the foreign factor income it's more, then we will get net minus. So here net foreign factor income minus 96 billion. That means the American resources supplied to production in the foreign country is 96. So that is produce other country product, other countries. So it should be subtracted, not domestically. And we already see to balance expenditure approach, income approach, we add some statistics discrepancy. That is, we should add because expenditure approach always greater than income. So that we should add. Then we should include consumption of fixed capital. So consumption of fixed capital we should include because in the expenditure approach, gross private domestic, the gross private domestic investment in the expenditure approach component, we didn't count depreciation. We didn't count depreciation. So to balance both equal, in the income approach, we should add that depreciation. Because in the expenditure approach, we didn't deduct depreciation. We calculate gross private domestic investment. Any capital we purchase include. But in the when we income count the profit or anything, the profit we deduct the depreciation. So to equal the balance, we again add the depreciation, that is consumption of fixed capital, that is depreciation. Consumption of fixed capital we should add because in this income component we deduct the depreciation. When we calculate profit of the proprietor's income or company profit, corporate profit, we deduct the depreciation. So we should add that depreciation into the income approach to balance the expenditure approach. Because in the expenditure approach, gross private domestic investment, we didn't include depreciation, we didn't subtract depreciation. So to balance, we had to include the consumption of fixed capital, that is depreciation, in the income approach side. So now the gross domestic product by the expenditure approach equal to the gross domestic product of income approach. So if you see the 2007 GDP, different countries, so United States, it's 13 trillion of dollars. So Japan that time second, now China is second. So earlier 2007 Japan is the second largest economy, now China is the second largest. So components of national income, this is not GDP, national income. National income will for the resources supplied by the household domestically or internationally. So all should consider the national income. For the GDP only domestically, the resources supply, the income for the resources supply domestically produced goods, that is GDP. Income from resource supply by the household and the domestically or internationally. So the components of national income: compensation of employees, rent, interest, proprietors' income, corporate profit. So corporate profit, the corporate profit include three components: corporate income taxes. So from that corporate profit, corporation should pay to the government income tax. So in the corporate profit, corporate income taxes also, and dividends. So company, for the shareholders, yearly or quarterly, they pay some dividends in money, that is dividends. And they company, they don't give the shareholders all the profit. As a dividends, they give part of the profit every year. Some profit they keep, and for the expansion of business. So that is undistributed corporate profit. So from the corporate profit, the corporation should pay for the government tax, and for the shareholders, the profit, part of profit, they every year they give to the shareholders some profit, and some of part of the profit they don't give to the shareholders, they keep for the further development, investment. And taxes on production and imports also we should include in the national income. So that is income for the government. So when we buy a product 200 rupees, so if the tax is 25 rupees, 25 rupees go to the government, 175 go to the firm, but household has to pay 200. So in the expenditure approach, we count 200 rupees. In the income approach, for the business, for the company profit, that means within the 175 rupees, they give labor, capital and other things, then they get profit. So to balance both sides, the income, that taxes on production and imports, that is go to the government. Then only both sides should be equal. Consumption, expenditure, household pay 200. So expenditure approach be include 200. Then here also we should income approach also we should count 200. But the 200, 175 go to the firm, that 25 go to the government as a tax on production. So in the income approach, we should consider taxes on production and import also. Then only expenditure approach, income approach, both should be equal. So income approach, so from national income to GDP. So in the we saw in the income approach, the left side of that balance sheet, we saw first we calculate national income. Then from that we get the GDP. So we deduct the net foreign factor income. We deduct because if the country citizen supply resources to produce in foreign country, that should be deducted because that product is not produced in the country, in foreign country. So net foreign factor income should be deducted to find the GDP from the national income. Then statistical discrepancy we should add, and consumption of fixed capital also we should add to the national income. To the national income, from national income we calculate GDP, we should subtract net foreign factor income, we should add statistical discrepancy and depreciation, consumption of fixed capital we should add. Then we will get GDP. So we can calculate other account, national net domestic product. So if we calculate GDP, then if we subtract depreciation, that consumption of fixed capital, then we will get net domestic product. From the net domestic product, we will get national income and personal income. So the government national, from the national income, then we deduct all the taxes, then we will get personal income. From the personal income, so all the taxes, corporate taxes, we deduct corporate taxes from national income, we will get personal income. Then from the personal income, we deduct the personal income tax, then we will get disposable income. That is the income household get. So in the national income, the household get disposable income. If you see this slide, so first gross domestic product. From the gross domestic product, if we deduct less depreciation, that is consumption of fixed capital, we will get net domestic product. So the from the net domestic product, if we deduct statistical discrepancy, then plus net foreign factor income, then we will get national income. So from the net domestic product, we deduct statistical discrepancy because we already include this statistical discrepancy in the GDP. So we deduct that one, then plus net foreign factor income. Already we deduct in the GDP calculation net foreign factor income. Now we include, then we will get national income. That is the national income is the resources supply by American or Sri Lankan get, whether it is that resource supply for the foreign produced goods or domestic produced goods. All that income come to the country, that is national income. Now our workers are working, laborers are working in Middle East. They are sending money to our country. That why they are giving their labor to produce foreign country. But for the labor, they get compensation. That compensation come to the Sri Lanka. That is, we should include in the national income, not the GDP. So when we calculate national income, then for the GDP, we should add this foreign employment remittance, because our labor supply to produce in foreign country. So that should be included in the national income, not in the GDP. So we add that net foreign factor income. Then we will get national income. That is the resources supplied by country citizen got this national income. But in this national income, something go to the government, taxes on production and import. So that is, and less social security contribution. So when you work, you something contribute to the social security contribution. So pension or EPF from your salary, they take it. That is social security contribution. You pay for the pension, other things. So that is, then we should be deduct that one to find the disposable income. Then corporate income taxes. So that will not come to household. The firm pay that taxes, that is go to the government. And also company keep some profit that will not come to the household, undistributed corporate profit. So, and government give some transfer payment that is come to household. So that is plus. Now the personal income. So others are keep to the government income, and corporate keep some profit. They don't pay it to the shareholders. So then this is the personal income for the households. Even that personal income, then government again tax, the income tax. Already corporate income tax, but now personal taxes. Then after that, disposable income. That is the one they can consume or spend. Okay, I will stop here, students. Okay. Hello, students.
Okay.
Okay, sir. Thank you.
Yeah, okay.
Thank you, sir.
Thank you, sir.
Okay.